What is up, guys? It's Cage here. Welcome back to episode 4 of my trading journey towards prop firm payouts. Today we've kinda got a break-even trade. It's a $20 loss. I'm not proud of this because I shouldn't have been in this trade in the first place. I didn't feel comfortable with this trade when I was in it, and I also did not follow all of my rules while taking this trade. Before we go over the technicals, let's look at the Excel sheet on what's going on there. Looking at the Excel sheet, I took the trade with 13 contracts. There's also an add-on included. I will enlighten that when I go over the technicals. I had a risk exposure of 0.75% on the account. The end result is minus $22, and this is what the wallet is at right now. Let's go over the technicals. In the last video, I've explained the high time frame of the whole NASDAQ. So today I'm just going to zoom in and talk about this local picture here on why I took this trade. First up, on the 15 minutes, when we follow our structure, we have a high and a lower low. So our local trend is also down. And you've just watched the replay and I placed in a long trade. So you think, why did you even take the trade? I don't know, guys. I don't know what was going on in my head. Let's keep looking at the reasons why I should not have taken the trade, and after that let's look at the reasons why I did take the trade. So on the higher time frame, my expectation after this new low, which we've just pushed above again, my expectation was that we could go towards our previous structure, which was this right here. But basically the rule is when you've got to push down like this, you can go to the 0.5 line, and that's your most aggressive way of getting a retest and get a move along with your trend again. And that's also what we did. We hit the 0.5 line, and that's when we also moved down. So we did not have any reason to come back up here for price to then go down. Looking at the 15-minute, you can see a bit of consolidation here, and I can draw in my range from there. Because when we follow our structure, we have a high, a low, and we're breaking above. So to draw our range from high to low, draw in our two starting points. This are deviation 1 or deviation 2, and this deviation 3 is where the trade happens. Let's extend our range points. So what was the reason for longing down here? Well, this is a TCT Model 1. It's a liquidity schematic that has the possibility to go towards the opposite side of the range when you have 3 taps below and below. Because each time the longers are getting stopped out and the market makers are possibly filling their orders here on the downside to then push price up towards the opposite side of the range. Looking at the time windows, London has just ended and we've swept the London low, the session after London, which is also a good sign for possible continuation the other way. So what are my rules for taking a trade? Because if you have watched the last 2 episodes, you can probably see I want a break of structure. I want to see that the market is ready to take liquidity on the other side. So after this sweep, what should you expect for more upside? That you should take some liquidity on the other side so we can build liquidity on another. But that's not what happened here. We've made equal highs, which is a sign that the market has grabbed not enough fuel on the downside to get a rotation towards the upside. So on this lower time frame here, we've made a SMT on the lows, and that's also the debate for me taking this trade, because we're leaving open liquidity on the bottom, but we have no reason to, because we cannot grab liquidity on the top yet. So I just got too focused on the local picture and I forgot my technical rules for actually taking a trade towards the right direction. Even though we have this liquidity schematic, it has never been confirmed that we can go towards the opposite side of the range. Even though there's so much juicy trend liquidity here, we have not gotten a signal from the market yet that it is ready to take all of this out. So what was my entry trigger here? Well, there was no trigger, but I was still in the trade. How can that happen? Well, what I want to see normally when you leave open a low, I want to see you break structure towards the upside. But that's not even what happened here, because in this whole down move, where's our structure? It was right here. So we would have to break this structure right here for in order to get more upsides. I did not wait for that. No, I was greedy and I placed it on this really ugly fair value gap. It's not even a fair value gap. Place the order on top of that, place the stop loss below the SMT, and that's when I tried to target parts of liquidity. This was my target because we had a 5-minute starting there. It was the end of the 10 minutes, but looking back at it now, I should never have been taking the take profit so high up there, because what is your resistance zone? It is right here. The market can tap in here and from there move towards the downside. So why should you have a TP all the way up there? You should have a TP right down here. So targeting liquidity in this case is a bad move because we are not ready to take liquidity on the top yet. This is the trade I took with 0.5 risk. Then where is the other 0.25 risk coming from? Well, what we had here was a small fair value gap, and because we've left open this low here, it was another confirmation for me to actually take a little add-on on this fair value gap towards the top, which of course you're already in a trade where you should not have been in, and then you're also gonna push an add-on onto the trade. Well, I'm not proud of it, but it still happened. And what happened then is the price actually started moving towards the targets, and we're almost up to our R here. That's with a 0.75 risk. That's almost $750. You should take profits there. It just front ran the TP there. But what I also should have done is, because the trade is almost up, I'm not in a trade I want to be, I should move my stop loss, because we've made a valid pullback towards the downside and then try to break towards the upside, which did happen. But what you should expect from the market then is you should leave this low open for another to get more expansion towards the upside, because again, my technical targets were all the way up here and we've never reached higher than right here. So that's another point to write down. That was bad management, and I also have to take this into the future trades I take. So the two big lessons I've learned from this break-even trade, because when the price was here, I just closed the position and I accepted the little loss and just moved on. So the two big lessons I've learned here: make sure you put your targets at realistic places, like I've explained on this 10-minute gap. Why would you place it all the way above, even though your resistance is right here? And the second one is really wait for your confirmations, because if this sweep cannot even grab liquidity from the top, then we're definitely just gonna move towards this low again and grab more liquidity on the other side. The market is not ready for you, and I was not ready for the market. I should not have taken action anywhere right here. Lessons learned. This was episode 4 of my trading journey towards prop firm payouts. I'll see you in the next one. Cage is out.